thanks to you all for being here today. This is essentially a repeat from a webinar that's been held in French 3 weeks ago. So we wanted to have a higher reach for this presentation and for the underlying paper as well. So Michael and I decided to make it in English as well, so to reach more people. So maybe a little more about ourselves before we move on to the agenda. So as Daniel said, I'm a professor in the Department of Mathematics. I'm an actuary, so I'm a professor of actuarial science, and my research interests revolve around flood insurance in Quebec and Canada. I'm also interested in natural catastrophe risk modeling, so more specifically in terms of the impacts of climate change on reinsurance and insurance of climate risks, floods and tropical cyclones mostly, as well as a financial risk sharing of climate risks. As Daniel said, I'm a member of the RISC network, the Intersectorial Flood Network of Quebec. I'm also a regular member of the Centre ESCAR, which is a climate science research center at UQAM, and I'm also a member of Contact and Gerard.
Well, thanks, Mathieu. My name is Michael Bourdeau-Brien. I'm a professor of finance in the Department of Finance, Insurance, and Real Estate at Laval University in Quebec City. My main research interest is on the geographic factor that affect investment and financing decisions. And it is in that context that I start using natural disasters and floods as exogenous shock to lessen the effect of endogeneity on my studies. Then after my first few research studies, I start centering my research on the impact of natural disasters on the stock market, on the municipal bond markets, on the housing markets, as well as the impact on firms and investors. Other than that, I'm interested by research on environmental finance, municipal finance, housings, and financial modeling. I am also a member of the RISC Research Network, and I'm involved in the expert community on housing of the CMHC.
Thanks, Michael. Thanks, Michael. So the agenda today, before we dig in deeper into the impacts of a lifetime limit on successive floods, which is the main topic of the presentation, we'll provide some background on the financial risk sharing of floods in Quebec and Canada. And then we'll talk a bit more about Quebec's disaster compensation program, some of the specifics. And then we'll talk about an important addition following a change in the program in April 2019, which is a lifetime limit. And then we'll talk a bit more as a conclusion on the future of financial risk sharing in the country. So if you're interested in the manuscript, so the complete manuscript is also available in English. So it's on our institutional depository, so on the Archipel at UQAM. So, well, I don't think you'll be able to click on the link, but still, if you look for document number 13310, then you'll get straight on it. This is forthcoming in a journal, Assurance et Gestion des Risques, Insurance and Risk Management. So this is a bilingual journal. Okay, so what do we mean by financial risk sharing? So to put it clearly, who pays for what? Okay, so this is basically a clear mechanism between various stakeholders of who pays for what. So who are the most important stakeholders mostly for financial risk sharing of natural catastrophes, for example? So we're talking about obviously citizens, government. So here in Canada, the federal and the provincial government, and the US also the states, obviously. We're talking about municipalities and also the financial services industry. So the banks, the insurance, and the reinsurance industry. So this kind of way of splitting the risk between the various stakeholders is what we call the financial risk sharing. It is very common for natural catastrophes. So how it works in Canada for flood insurance? Well, first of all, we'll focus I'd say, unless otherwise stated, we'll talk mostly about single-family homes. Okay, so for citizens. So in terms of financial risk sharing, 2013 is a very important year. So before 2013, flood was not covered as part of the basic homeowners insurance. There was a sewer backup rider. Okay, so a rider means optional protection. But in terms of overland flood, while no protection was offered in the insurance industry. Then what happened is the Calgary floods in 2013, which triggered a much greater involvement of the insurance industry, so that I'd say about maybe 2 to 3 years later, depending on the regions in the country and depending on the company, a rider was introduced for overland flood losses. So what is the state of flood insurance in the country after 2013? Well, in terms of the basic homeowners insurance, flood is still not covered, but there's this rider that is now available. So this overland flood rider that has been introduced is still optional. And now it's mostly sold as part of a larger product, which is known as water comprehensive product, that includes both overland flooding and also sewer backup. So as of maybe about 2 years ago, from what I read, about 80% of the insurers was offering the rider, and when I say 80% is in terms of premium volume. And from what I've been told, the take-up rate is approximately 30 to 40%. I've seen Chris Roll is on the list of participants. Maybe the IBC will be able to provide more details about more recent details about the take-up rate. So that being said, the rider in itself is not necessarily offered to everyone, since the rider obviously its premium is based on the risk. For high risk areas, it's really difficult. This product is really difficult. It might be difficult to get. So either it's not available, or the coverage is insufficient, or is simply not affordable. So for those in high risk areas, so those in the 2 to 20 year return period, such insurance is not necessarily targeted for these citizens. So here comes the provincial disaster compensation programs that help these citizens. So these provincial compensation programs help and supports directly the disaster victims, but the federal government will also help support the provinces through the disaster financial assistance arrangements. So the DFA does not support directly citizens who have been victim of a flood, but it supports the provinces. Okay, so that's an important reminder. So in terms of the schematic of how it works in the country, well, if you're covered by an insurance company, then you're on the left part of the illustration here. So you see if you're covered by an insurance company, then it's most likely that the insurance company in itself will also reinsure part of its portfolio to a reinsurance company. And if you're not covered by an insurance company, then it's the provincial disaster compensation program that will pay, that will support the disaster victims. And if the natural disaster is very important, then there's a risk-sharing formula between the federal government and the provinces, which is predetermined, for which the federal government helps support the provinces for natural disasters that have been too important. So for example, in 2017, the penetration of the flood insurance was not as it is in 2019, 2020. So a big part of the losses suffered by the disaster victims in the floods of 2017 was assumed by the provinces. So for example, if I remember correctly, in Quebec, the province received about $300 or $400 million from the federal government in terms of compensation from the DFA, because the catastrophe in itself was important enough to trigger a much more important compensation from the federal government. So the compensation from the DFA is really proportional to the number of people living in the province. And when you normalize the total losses in terms of the number of people, then there's this risk sharing formula that applies here. So for this, between the province and the federal government. So now Michael will follow with the specifics of the Quebec program.
Well, yes, thank you, Mathieu. I'll talk a bit about the Quebec Disaster Compensation Program. It is called the General Financial Assistance Program regarding actual or imminent disasters. It is managed by the Quebec Ministry of Public Securities. And the financial aids is targeted to communities, businesses, as well as to individuals. Of course, our paper will focus on one category of financial assistance to individuals. The assistance to individuals can be split into two large groups. The first one is the aid for preventive measures. People can ask up to $5,000 to obtain some money to compensate themselves for the preventive measure they put in place. But the bulk of the money is offered for the restoration works or the rebuilding effort. That includes some monies for to cover the cost of temporary housing and storage, to buy new movable property when the property was damaged in the flood. And of course, it provides a lot of money to repair the main residence. Mathieu, could you just switch from the other slide? Thank you. So in terms of financial assistance to homeowner, some kind of incentive that are included in the Quebec Disaster Compensation Program are arguably less well known by most people. Among other things, people can get monies to better protect their main residence. In terms of, they can put in place some flood proofing measures. They can also benefit from some allocation to move their main house to a different location on their land parcel or on a new land parcel. Or they can also benefit from a buyout program that is embedded in the financial assistance program in the form of a departure allowance. If we look back in time, these three risk mitigation measures were already in place in 2003. But most of the program is about financial assistance for damage, for repairing the damage to the main residence. And in that context, the amount available to the flood homeowner has increased over time. As of 2018, people can get some compensation from the cost incurred for the repair, for some compensation up to 90% of eligible damage, up to the cost of replacing their residence, or a maximum of $200,000. And it is good to note that eligible damage does not cover what is insurable. It does not cover the loss of income, or it does not cover other kind of damage that we call indirect damage. But what is really of the prime interest for us is a new section that has been had in 2019 to the Quebec Disaster Compensation Program, a new section that is dedicated to successive floods. So in that new section, as of April 2019, it distinguished between homeowner who request compensation from the program from a first time, so people who address a first claim to the program, from people who do successive following claims to the program. If it is the first time that someone needs help from the provincial program, well, the program is quite as before April 2019. The homeowner can get money for rebuilding or benefit from the flood proofing, the relocation, or the buyout options. But if this homeowner has already has already received some money for the rebuilding, then he became subject to a new lifetime limits. Under the following claim category, the homeowner can still get some money to compensate for the damage. He still get 90% of eligible damage, but the maximum amount he can receive is much lower than before. The maximum amount is now 50% of the cost of replacing the residence, or $100,000. And not only is that amount lower than before, but that amount is cumulative over the life of the homeowner. So for example, if someone need $50,000 in 2020 for a flood, then he can only get, if he experiences a third flood, another $15,000. So it modifies the incentive to benefit for the flood proofing, the relocation, and the buyout option. And this new lifetime limit has a clear impact on the financial analysis that someone can make of what he is expect to receive in the future. And this is the base of the motivation behind underlying our research paper. Mathieu, next slide. Miss, thank you. But although we know right from the start that it affects the house owner, it is not clear on the end what will be the end effect of the new lifetime limit. It is not clear in part because it's new in Canada and we have few comparable elsewhere in the world. Also, we didn't see any immediate effect when the new decree came into effect with the lifetime limit in 2019. All of the 2019 claims falls under the first claim category. So the impact of the lifetime limit will only begin to materialize over the next few years. It is kind of a complex option, and we believe it is not only interesting, but it is really important to analyze, to assess the effect of the lifetime limits on the financial implication to households. And of course, if the government offer less money to homeowner in high-risk location that suffer from many floods over the years, then there's kind of a risk transfer from the government to the homeowner. And this affects the financial risk sharing that Mathieu was talking about. And it is in that context that it modifies what we call the social covenant that unite the government, insurer, and other parties prenantes, other stakeholders in the society. So what we do now in our research paper is really to assess as a first step the effect of the lifetime limit. And to do so, we need to put in place some basic assumption, and we use a simulation process to analyze the effect that the lifetime limit can have. So now in terms of assumptions, first, it is good to remember that we focus only on rebuilding. At each node in our simulation, the homeowner affected by a flood will choose to rebuild. He won't have the option to flood-proof, to relocate, or to buy out. These are important risk mitigation options. And in the next few months and years, Mathieu and I intend to analyze these options and to add some complexity to our simulation process in order to take into account these options. But as of now, in the current paper, we are really focusing on rebuilding. Imagine that you are a homeowner that has been flooded in 2019. Our simulation began in 2020. So every flood that will occur in our simulation will fall into the following claims category and will be subject to the $100,000 limit. And to analyze the effect of that limit, we use what we call a stylized actuarial frequency severity approach. What we mean by stylized is that we keep our model quite general. We use some variable as input to characterize the ex-ante risk linked to a given location. But we do not put a house somewhere in the map and take into account the particular feature related to the geography, topology, and so on. So our model really stays general. We do not address the fact that we are near a given river. We do not address the fact that we are on higher ground and so on. And as I say, we use a frequency severity approach. So we first analyze the frequency that gave us at every node in our simulation the answer to the question, is there a claim? Is there some damage from floods? And then if there is a damage, we go to the second step, the severity steps that give us the cost that the claim will, that the amount of the compensation that is requested by the homeowner. As I said before, there's no immediate impact from the lifetime limits. We need to assess the effect over several years, and we choose to do so over a time horizon of 25 years, which is quite similar to the typical mortgage duration here in Quebec. And in our simulation process, we simulate 100,000 different paths. In each path, we have a property that is characterized by a different level of ex-ante risk. We can think about it as a different location. And for each path, we draw annually the frequency and then the severity over 25 years. Now, more on the frequency sides. Mathieu, can you just switch to the next slide? Thank you. So we have two measures that are associated with the frequency. The first one is an input, the risk level. That's kind of the location of the property that we use in a given path. The location is expressed as a return period. So we know right from the start that the property is located in a 2-year floodplain or in a 100-year floodplain. That location, that risk level doesn't change throughout the 25 years. Then each year we draw the flood event that we also express as a return period. We can interpret the flood event as the flood depth. The higher the return period, the higher the water depth in that year. And if the water depth is higher or equal to the floodplain location, to the risk level, then there will be a claim, there will be a flood. Other than that, the house won't be flooded that year. It is important also to note that the flood depth that we generate annually has no temporal dependency. So the flood depth that it is reached in a given year is not linked in any way to the flood depth in the previous year. So if we take an example for a 20-year floodplain location in the table at the bottom of the slide, well, just stay to the same slide, please, Matthew. Okay, thank you. So if we take a 20-year location in 20-year floodplain, that house won't be flooded if the flood depth reach 2 years flood depth or 10 years flood depth, but will begin to suffer from some damage if the flood depth is higher, is of 20 years, 100 years, or higher than that. Next, if there is a claim, we investigate what is the cost of the claim with the severity. In terms of severity, we also need some basic assumption. The first one is the value of the building. So in all of our simulation, we take for granted that we have a building that is worth $250,000, and that value is constant. This assumption, well, Mathieu and I had a lot of discussion about that assumption because it basically means that there is no depreciation in house value following a flood. And why do we use that assumption? Is that there's no consensus in the scientific literature about the effect of a flood on the value of a house. Many papers look at the immediate value following the flood, and they provide various answers. The depreciation range between basically 0% and 40%. But longer-term studies that examine the effect over 5 or 10 years see very few effect of a flood on house's value. And here we take for granted that house have been rebuilt. So there's some paper that try to explain the fact that the house discount seems to disappear over a few years. And this study basically use two subjective factors that they call the investor myopia and investor amnesia. Myopia means that investor have the difficulty to foresee what will happen many years in advance. So if the risk of flooding will materialize 5 or 10 years in the future, it is difficult for most households to assess the real effect as of now. And amnesia means that people forget about past events. Other than the house value assumption, we also provide as an input two types of property that account for the fact that property have various exposure and vulnerability to flood risk. We have the low exposure house and the high exposure house. In the low exposure house, well, water will take some time to reach the first floor, and we know from past literature that the first floor is one of the most important factors to determine the amount of damage to a property. So if water takes time to reach the first floor, then if there's a flood, if there's, for example, a 20-year water depth in a 20-year floodplain, well, the amount of damage will be quite small because the flood will basically affect only the basement. So in the table at the bottom of the slide, for 20 years floodplain and a 20-year flood depth severity, we have a flood that caused damage that equal to 10% of the house value. But if we have a same house in the same floodplain, 20 years floodplain location, but a house which is at a high exposure type, then the same water depth, 20 years water depth, will cause much more damage, and the severity will be at 50% of house values. So with these assumptions in head, we'll give Mathieu the chance to show you the main result that we obtained from our simulation.
Yep. Thank you, Miguel. So maybe a few additional words just to complete on the assumption. So here the idea is really to get a sense of the aggregate loss distribution that any homeowners might face if say today we have to take a decision on whether to stay or to take another option. Really the idea is to look, okay, over 25 years, if you've got a mortgage, here's the total loss that you might suffer overall, okay? Not just the average loss, but also the entire distribution with probabilities. And it's the evolution of these losses over time that will obviously, in the end, it might trigger the lifetime limit. And that's what we want to analyze. So there's no intermediate decisions because we really want to know, hey, if someone wants to stay in their home and without applying any further protection or and without applying any other option, is the question is, okay, how much losses are you going to suffer in the future, and when are you going to reach the lifetime limit? It's also important to emphasize that the modeling approach here is really, really general. Okay, you won't hear us talk about a specific city or a specific river. Okay, it's really everything is defined in terms of return periods. Okay, so I mean, a return period is a return period. There's an associated probability with that, so it doesn't change. The only assumption that one can change over in our analysis is these damage curves that Michael presented. Okay, so depending obviously on the property and on the terrain, there's going to be there might be a different distribution of losses, but there's also so much uncertainty in assessing the exact losses for specific properties that we felt that in the end, okay, let's just start with a baseline with these percentages. Some of them might be a bit higher, maybe a bit lower. It's just to give a sense of what will happen over 25 years. And as you will see, the biggest driver of losses over 25 years is obviously the number of floods. So here in this table, okay, there is no loss. It's really just the number of floods that one might suffer over a period of 25 years. Okay, so if you're in a 20-year floodplain, there's only a 28% chance that you will not suffer any flood over 25 years. Okay, so every single year you have a 5% probability of being flooded, and you repeat that experiment over 25 years. So you have to be, so there's only a 28% chance that you won't be flooded, and there's even like an approximately 23 plus 9, so about 35% chance that you might even have 2 floods or more over 25 years. And that's when obviously the lifetime limit will be triggered. If you're unlucky enough to suffer more than 1 flood over 25 years, then obviously the limit will be hit. Even if you're in a 100-year floodplain, there's a probability of 23% that you will suffer at least 1 flood. So 78% that you will suffer no flood. And even in a 1,000-year floodplain, you might think you will be extremely safe. Well, there's still a 2.5 chance that you'll get flooded at least once over 25 years. So in terms of risk, it's still significant, obviously, when you accumulate that over 25 years. So whenever we need to look at the lifetime limit or any decision that we have to undertake in terms of protecting a home or relocation decision, for example, you have to look at a long horizon, because over a long horizon is the frequency of floods that will hit you hard. So on that table, it's really just the number of floods. No losses, nothing. It's really just a repetition of being at risk every single year. So now on this table, on slide number 18, there's a lot of things. Okay, so really here the idea is that every time there's a flood that's been simulated, we calculate the loss according to the damage curves that Michael presented earlier. Obviously, depending on the severity of the flood, it's possible that one might suffer more or less losses. That's what we want to take into account. So we project losses over 25 years, and depending on the ex-ante risk, where you are on the floodplains, then obviously the severity of losses will be different. So here we have highlighted people who are located in a 20-year floodplain. We have the aggregate loss distribution over 25 years. So I'll take my virtual laser to show you that how to interpret that. So here, this 100 grand figure means that there's a 10% chance that your losses over 25 years will be greater than 100 grand. Okay, there's even a 1% chance that your cumulative losses over 20 years will be over $250,000. Again, that's what I said. I mean, it's the number of floods that will hit you hard over a long time. So if you repeat that, and you might be unlucky enough with a 1% chance to get losses above $250,000. And this is for a low exposure kind of property. And obviously, if you have a high exposure kind of property, where water reaches very early on the first floor, and obviously the numbers are out of this world. They are proportional to the risk, obviously, but we wanted to accumulate these losses over 25 years. In the last column, we have the average annual loss. Well, essentially, it's really just the mean aggregate loss divided over 25 years. So for someone who would be in a 20-year floodplain, here in this really stylized example, we would expect approximately $2,000 in annual losses on average. For a high exposure property, well, obviously, if the water gets to the first floor very quickly, then the average annual loss is much higher than that. So that gives you a sense of how much losses one might suffer if you accumulate over 25 years and you naively rebuild every time. Okay, so that's the aspect. Okay, over 25 years, you have to be lucky enough to not suffer more than one flood. So depending on where you are in the floodplains. So on the next slide here, we want to look at the probability of reaching the limit and the kind of losses we should expect in excess of this lifetime limit. Okay, so you have, again, this 25-year time horizon. Okay, you accumulate the losses, and now we are looking at the timing of when you might be reaching the lifetime limit of $100,000. Obviously, this limit, the ease with it, how we reach this limit obviously will depend on the value of the home. Here it's $250,000. It will also depend on the ex ante risk. But for a home worth, for a building worth $250,000, what it means is that over 25 years, there's a 10% chance that you will reach that lifetime limit. Okay, it's really significant. And what's even more scary is the right column on the right-hand side, is if you are to reach that limit over 25 years, how much should you have to pay on average to assume all the losses once you reach that limit? That's the last column on the right. This figure, $72,000, means that once you have reached the limit, that's it. There's no more protection coming from the Quebec government. That's on average how much money you should take out of your pocket to pay for flood losses, even if the first $100,000 have been paid out by the government. So that gives us a sense of how much financial stress that might put on a household if someone decides to stay ultimately and attains that limit. You could take a decision to wait until you're close enough to the limit to take a decision and to move out. But if you're unlucky enough that in a year or two you get a major flood and then you just cross that limit, then that's the amount of loss you might have to suffer. So that's very important. Obviously, for a high exposure property, again, the water gets to first floor very quickly. So the probability of reaching that limit, again, is proportional to the quantity of losses that you might suffer. So this probability of reaching that limit is extremely high. And the amount of loss in excess of $100,000 is about $150,000 overall. If you're in a 100-year flood zone, floodplain, your chance of reaching the limit is quite low. But if it does happen, and if you're unlucky enough to suffer from a severe flood so that your losses are in excess, then your average loss is still about $20,000. So that's, again, non-negligible. We also wanted to get a sense of the insolvency risk compared to having a mortgage. Okay, so here on slide 19 we have a good overview of how much money one will have to pay if you reach that lifetime limit. But here we wanted to compare the accumulation of losses over 25 years compared to the amortization table of a typical mortgage over 25 years, okay? So here, obviously, there are more assumptions to define insolvency. So I do like slide 19 because you don't need to put in extra assumptions on the kind of mortgage, the interest rate, the amortization period, and whatever. But here, we really wanted to get a sense of if we have a typical mortgage on that house, let's say in a 20-year floodplain, when will you be more likely to default on your mortgage because of the introduction of the lifetime limit. So here, that's why we projected losses over 25 years. We have this mortgage amortized over 25 years with a borrowed amount of $250,000, just like the value of the building. We don't account for the value of the land. It's as if it was already paid, so there's more or less enough cash in the beginning. We'll also assume that the value of the property is stable over time, so there's no appreciation nor depreciation following a flood. Again, as Michael said, it's not clear where this should go, but at least we just want to get a sense of the timing of when default might occur. We also assume that there's no additional cash, no additional savings from the borrower. And the only way that someone can repay for the losses is based on the coverage from the government and from the freed balance on the mortgage. So whenever you have a mortgage of $250,000, on every monthly payment, you pay a large share of interest and also on capital. So the more you pay on capital, the remaining balance goes down, and that frees up capital for a household to pay for the losses. So essentially, we define here insolvency as a first moment when the losses above the lifetime limit exceed the homeowner's borrowing capacity. So if the mortgage balance is too close enough to the borrowed amount, there's not enough borrowing capacity, and if you reach out the lifetime limit, then you're insolvent. So that's more or less the assumption. Obviously, it changes from one person to the other. There might be additional personal savings and everything, but it's really just to get a sense of the timing of the cash flows involved with a lifetime limit compared to the depreciation of the mortgage. So with respect to the amortization of the mortgage. So in this setup, someone who is located in a 20-year floodplain is subject to approximately a 2% insolvency risk or default risk on a building of $250,000. So here the idea is quite simple. We look at the value of the mortgage balance compared to the cumulative losses. And here the insolvency risk, we computed it over 10 years. Here's why. That's simple. After 10 to 15 years, normally if your amortization is over 25 years, you'll have enough capital, you'll have enough equity on your home to pay for the additional losses. But if you're unlucky enough to have maybe 2 floods in the first couple of years of the mortgage, when there's not enough capital released on the mortgage, then you hit the lifetime limit, you don't have enough cash, and then you might skip a payment and you have a mortgage default. So it's really like this this exemplified approach that we used. Again, we can complement slide number 21 with slide number 19 in terms of the amount of cash that one has to have set aside in case one reaches the limit of $100,000. But here in this setup of a 25-year mortgage with this kind of cash and everything, this kind of setup, that's what we might face. Someone who has a high exposure in a 20-year floodplain, then obviously the insolvency risk is much higher. This is the kind of thing that we can really easily recalculate depending on the parameters of each of the homeowners. So obviously these numbers will change, but what it illustrates is that there's a high mortgage default risk over the first couple of years of the mortgage, because if you're unlucky enough to suffer a few floods on top of not having enough equity released on the mortgage, then that's when it's gonna hit you hard. So if you remember the title of the paper, says lifetime limit on successive floods towards a new social covenant. Well, in fact, what's this new social covenant? Well, it's really like the carrot and the stick. So yes, it has in the Quebec compensation program, it has features where it encourages flood proofing, moving out from floodplains. But if you don't get into these options, then there's the stick, a lifetime limit on successive floods. It might hit you hard if you're unlucky enough. As Michael said, there's a significant risk transfer to citizens. In fact, it creates an important protection gap. That's because what I assume is that, what we might assume is that once you have reached that lifetime limit, well, first of all, government won't pay for any extra losses on top after the lifetime limit, and you're probably not insurable as well. So there's no more insurance available for you, neither from the industry or from the government. So there's a protection gap here. And also, well, obviously, depending on some of the assumptions, we also think that insolvency risk might be underestimated. Before you get your money from the compensation program, there's a lot of administrative delays. There's handling times for the cases. So obviously, it doesn't take like a couple of days to get your money. It might take several months. So it obviously adds a lot of financial pressure. And also what we have to emphasize is that only real direct, and there's also the indirect damages that are not accounted for. And also, if you look at the details of the program, for us, we really just made it simple. It's like, okay, it's 50% of the value of the home in terms of loss, and we assume that the government pays for that. But if you look at the very specific details of the program, what you'll see is that it's really like minimal coverage. It's there's a coverage for one fridge, but probably not for a second one. There's a coverage for one bedroom in the basement. Well, now I'm getting to the details, but what I'm saying basically is that not all losses are covered. It's really like essential or minimal losses. So in the end, you won't necessarily get an entire compensation for the true losses. So that might also put some additional financial pressure, meaning that your insolvency risk might happen earlier over time because not all losses are compensated. So as you can expect, there are significant impacts on borrowers. So there's this mortgage default risk, and obviously on lenders and mortgage insurers. So banks and the CMHC in terms of mortgage default insurance. So that's so we see the kind of impact that it might have. So just by the introduction of this lifetime limit, how it can affect, for example, insolvency, and we're not even talking about the possibility of climate change, the fact that maybe we might be underestimating the true flood risk with the revision of the flood maps. So as you could see, it's really like an abstract way of seeing risk. There's no climate change. So if you want to more or less assess the impact of climate change, it's as if we move someone from the 20-year floodplain, let's say, to the 10-year floodplain, and the impact is straightforward from a 2% insolvency risk to 4%. So that's one way of doing it, but it doesn't mean that the risk will double everywhere. So it's obviously, we wanted to get something out that was independent from assumptions on climate change. We just wanted to have these results just to get a sense of what happens over 25 years. As Michael said, those are very complex options for citizens and municipalities. So for a citizen, you have to consider on top of the lifetime limit, okay, there's the possibility of buyout, relocation, and okay, what's the most advantageous option for a citizen or for a municipality to recommend to its citizens? It's really not obvious, and it's really like the bulk of our research projects that we'll be having, Michael and myself. Well, we have listed here two of the partners. We might also question whether or not the Quebec government will truly apply this lifetime limit in the future. As you know, these compensation programs are easily modified by decree. So if there's a new, if in Quebec we're lucky enough to have no major flood prior to the next election, then maybe the next government will just change this lifetime limit. We don't know, but it's easily adopted by decree, just like it's been done in 2019, just like it's been done in the previous years. So we don't know yet. In terms of the future of financial risk sharing in Canada, the first item is the National Flood Action Plan from the Insurance Bureau of Canada. I attended the CAT-IQ conference in February, so I really took notes really quickly, so I'm not sure if everything is there. So if Chris is still there, then IBC will be able to provide more details about that. So it's really like a proposal from the IBC for different flood zones, who could assume the risk in the various flood zones. So for example, there's this suggestion or this proposal of having an insurance pool for those in the high risk areas, whereas in the highest risk, we might encourage more buyout, relocation, retrofitting, strategic retreat, which I guess is more or less equivalent to relocation. So, so these kinds of options are on the table. There's also maybe Canada could have also its own flood insurance program. It's been very briefly mentioned during the electoral campaign in 2019. It went under the radar during the campaign for various reasons. But from what I understand, we're talking about affordable insurance for highest risks. I don't have much more details. But that's the state of the future in terms of financial risk sharing in Canada. So a lot of things going on right now. So that's the end of the presentation. So we'll take questions from now on. I don't see anything in the chat though.
Yeah, exactly. You can use the chat, or you can just unmute your microphone and yeah, address the questions to Mathieu and Michael.
Hi, it's Joanna Aiken from the Intech Center. I just had a question on, I mean, I live in Montreal, and obviously I think the insurance kind of the people in finance and insurance are probably well aware of this. Do you have any view on how aware like homeowners are of the changes that have come through?
Excuse me, can you repeat the last part?
Do you have an insight into how aware you think like the homeowners in Quebec are of the impacts of this change? Do you think there's any awareness, or?
Well, not much. That was,
yeah.
To be honest, that was one of the key reasons that we got into that paper. We wanted to get the info out that, hey, by the way, this lifetime limit might hit you hard, but I mean, I guess it's really difficult for people to foresee what might happen in 25 years time. But that's really the case here. I mean, that's what we wanted to do. We wanted to explain, for example, how much risk is being transferred on homeowners. But we are slowly getting our way not diffusing, but in reaching people. And we've written an article on the conversation. Well, it was in French, but it's really just to get the word out. But it was published like in April, well, last April. So as you should guess, it went under the radar as well. So didn't get a lot of traction, I guess. But I'm hopeful that in the next couple of months and years, we'll be able to make people aware of the impacts of that. And with the projects, with the IMF, GRIF Fund, and also with the CMM, Montreal Metropolitan Community, well, we'll be able to put figures, numbers on these options for various parts of Montreal. So that will help get the word out. Thanks.
So I see two questions in the chat, Mathieu.
Yeah.
So if you could read them out loud.
Yeah, from Chris, I'd be happy to provide you with information about the IBC proposal. Are you looking at strictly riverine flood risk, or are you also including pluvial or coastal storm surge? Well, what I had in mind in terms of discussion was more riverine flood risk, so that's what I kind of figured. But I understand that it has to be a broader discussion. So if you want to jump in, Chris, please go ahead.
Yeah, I just wanted to sort of make sure I was what I was looking at in terms of the numbers, and just so that people keep in mind that all of the figures could actually be significantly larger, because that urban flooding or coastal flooding are additional sorts of things that could drive costs.
Exactly. Yes, that's a very good point. But we mostly focused on riverine flood risk in this presentation.
Okay, good to know.
Thanks, Chris. From Bernard, do you?
Yeah, I can maybe repeat the questions. I think my corrector is playing tricks on me. What I wanted to know is, do you foresee banks using this kind of model to grant loans, or in the future with the?
I hope so.
You hope so?
I hope
okay.
so. I know in the U.S. there's a lot of discussion about who should assume mortgage default risk for those who are in flood zones, especially in the coastal areas with hurricanes. But well, we don't know yet. Well, precisely the impacts on mortgage default of climate change, but I do hope that banks should use that in terms of underwriting mortgages, because that'll become important.
Right. And you think we can streamline the model precise enough in order to be specific enough for the specific loans to be granted versus another one that would be denied?
Yeah, right. Well, our approach is as good as the hydrology and as good as the hydraulic maps that one can be provided. I mean, what we did is just that, okay, if you're in a 20-year floodplain, well, this kind of event appears with a 5% probability. So no matter what is the kind of river or whatever, and it happens on average over a very long time range, once every 20 years. So that's only the kind of thing that we replicated. If a bank has really like detailed information provided from CAT modeling service or provided by the government or any other sources, as long as you have like these flood hazard maps, a high resolution flood hazard maps, and you know where are the different return periods, and if you have enough information on the flood depth, then you can have a very precise overview of your flood risk over 25 years. Because what we did is just adding like the actuarial approach to projecting losses. So it's free from any other assumption in terms of river and city. So as long as you get those hydraulic maps, then you apply it, and you get this exact view of risk for your specific mortgage. So,
and Mathieu, I will add something here. In the US, we have some evidence from some research paper that the bank are able to assess the level of risk associated with flooding. In fact, many banks simply get rid of their high-risk loans by selling them to the GSE, the agency. And they keep in their home portfolio the loans that are at lower risk of flooding. So there are some evidence that the bank are already able to distinguish high risk and low risk property.